All right, so this is going to be another budget video. So obviously there's been a lot in it and we've had a fair bit of feedback. So again, thanks for those who have provided that feedback and had some pretty interesting discussions. And so what I wanted to do is sort of peel through some of those, the main questions people have asked, because we have been asked for a bit more detail on very specific topics. So we're going to start off by looking at a couple of the basic questions around timing and whether these things will be passed, etc. The short version of that is, yes, we think most of these measures are likely to be passed. Now, that's not to say that the discussions around the government maybe changing their mind or walking some of this back might happen, but the reality is they control both houses of Parliament well enough to, in theory, be able to pass whatever legislation they decide. So we are proceeding at this point on the basis of it's likely that these measures will be passed, notwithstanding they may decide to, walk back some of them because the fallout seems to have been pretty substantial. So we're proceeding at this point as if they're going to be passed, partly also because these measures don't come in till at least July 1, 2026, so the 2027 year. We do have a bit of time if and when the actual legislation is passed. And more importantly, until it's passed, we don't know the detail. So we can speculate as to what sorts of things may be sort of coming. And that's a little bit what I want to talk about today, because people have asked us, well, what might this mean if it does get passed as it is? What might this mean for discretionary trusts in particular as a tax planning vehicle and things like investment companies, bucket companies. So what we're going to do now is walk through what the current scenario, what the historical scenario has been around trusts and bucket companies. Now, in the long form video we did recently, I went through and explained some of the reasoning why the prevalence of these strategies have exploded in recent years. And essentially it comes down to this. Okay, so what this graph shows is the number of taxpayers, the number of individuals that essentially have been caught up by bracket creep. So this is going back to 2015-16. So again, if you look at this from a purely, mathematics perspective and a quantum, lots more people have been, and we can see the numbers exploding in the number of trusts that have been set up and are now doing, let's call it tax planning. Two reasons. One is way more people have the wealth worth protecting, and trusts are first and foremost, regardless of what many people might claim, they're first and foremost a protection vehicle, not a tax planning vehicle. And I'll explain why when we get into this a bit more detail. But the number of trusts being set up have increased, partly because way more people have way more assets. That's just a function of inflation and numbers going up over time. But especially the fact that, so they want to protect that capital from, be it family law, bankruptcy, or other potential attacks on that capital, particularly in the family trust domain. But also, from a tax planning point of view, is yes, they do want to be able to use tax planning strategies, in particular, streaming through to investment companies. So the question is, well, why didn't they go straight to investment companies? Why are trusts used as the primary vehicle rather than going straight to investment companies? Well, this actually goes back to the capital gains tax changes made in 1999, which Chalmers is essentially suggesting that he's sort of unwinding or going back to. So let's walk through initially a little bit of history so we can understand exactly how do we get to where we are, and therefore why have tax planning strategies changed accordingly. So let's start with what the basic scenario is in terms of a trust and bucket company setup. Okay, so what a trust is, again, a trust is a legal relationship, not a legal entity per se. So in a trust, we have a trustee who owns assets on behalf of the beneficiaries. Okay. And it's a trustee who decides, if it's a discretionary trust, it's the trustee's discretion, okay, as to who, when and how beneficiaries receive either income or capital of the trust. But a trust must distribute its taxable income every year. Otherwise, it basically pays top marginal rate. So it makes sense for the trust to distribute that. So if it can distribute that taxable income to a beneficiary who has a lower than top marginal rate, then obviously it makes sense. Even if you still want to essentially reinvest that money, it still makes sense to distribute that to a taxpayer with a lower tax rate and either lend the money back to the trust or essentially gift it to the trust so the trust can reinvest that capital. Okay, so trusts have become increasingly popular, partly because back in 1999, when the indexation rules were replaced by the discount rules, is prior to 1999, all capital gains were indexed. Okay, so regardless of the taxpayer, companies, trusts or individuals, whenever you bought an asset, then you got to index essentially in line with CPI, the cost of that asset, and you only paid tax on the gain. Okay, so you will see some commentary around claims, particularly from the government, to say, well, going back to indexation actually materially isn't that much different to a 50% discount because depending on your rate of return, if your rate of return, for example, is roughly double inflation, so if inflation is tracking at 3% and your growth return is, say, 6, roughly, then essentially you're only being taxed on 50% of the gain anyway because your index base is going to kind of match that. And that the math of that can work out to be more true than not. So let's accept that as a provision. So yes, if growth rates are roughly double inflation, then in theory, you're going to be in a similar position if you have that indexation. However, what that doesn't recognise is back in 1999, when trusts and individuals got the 50% discount for capital gains, companies did not. So companies went from being, again, paying company tax rate, which is now essentially 30% for investment companies. Companies went from paying their tax on the net or the real growth in the value of their assets to now paying it on the entire gain. So instead of, again, if we go back to that example of, say, a growth rate of roughly 3% inflation and 6% growth, the company is going to pay tax on the gross gain on its assets, i.e. 6% compounded, whereas a trust is going to pay it on 50% or 3%. Okay, so the advantage of putting growth assets or assets where the gain will be realised at some point in the future in a trust or being housed by an individual was significantly greater, double the rate essentially for a company, because a trust could pay 50% effective tax rate based on not just the gain, but what it would end up distributing that assessable portion to an underlying tax base. So let's walk through an example because there's a fair bit in all that. So let's say a trust is able to realise a capital gain, whatever the amount, but they can pay that gain through the assessable portion, so 50% of that gain now is being passed through to a taxpayer on, let's say, a 30% tax bracket. The effective rate of tax, therefore, for that gain for the trust is going to be 15% because half the gain is going to be transferred to someone who pays then 30% tax on it. The other 50% is not assessed for income tax. So the effective rate of tax for gains in a trust is going to be a maximum of half the top marginal rate, okay, which being at 47% is going to be 23.5%. But if it can get through to a taxpayer with a lower bracket than that, then it's going to be half. Again, if the taxpayer was the 16% tax bracket, it would be 8, and so on. So there's clearly a huge advantage on paying tax at a maximum of 23.5% by realising that gain in a trust, rather than putting into a company where the company is going to pay 30% tax in every single case. Okay, so that's why tax planning very much altered towards putting growth assets in discretionary trusts so that the amount of tax paid, and therefore even if that capital is to be reinvested, the amount of net tax paid is going to be significantly lower. Now, where does the bucket company come in here? Well, if that beneficiary of the trust is a company with a tax rate of 30%, again, 50% of the gain is assessable. So 50% of the gain, let's say there's a $100,000 gain realised in a discretionary trust. So 50,000 of that's going to be assessable income to the trust. If it distributes that 50,000 to a company, then that 50,000 is going to be taxable at 30% in the company. Okay, so it's going to pay 15,000 tax. In other words, it's going to be the trust company setup is going to pay $15,000 tax on a $100,000 gross realised gain. Now, talk a little bit in a minute about whether that gain is truly equivalent to income, but in terms of this example, that $100,000 gain, the effective tax rate on that before the trust can reinvest its 50,000 and the company can reinvest its net 35, we've got essentially $85,000 worth of capital being reinvested across, let's call it the family entities. Okay, whereas if the company realised that whole 100, it would have paid 30 and only 70,000 would be reinvested. And similarly, if that was paid out to a top marginal taxpayer, then 47% would be paid and only 53% of that could be reinvested, be it back into the trust, back into the company, or by the individual. So you can think of the compounding effect of that net reinvestment over time is going to make an enormous difference to the growth in overall capital of the family assets. So it made perfect sense mathematically for trusts to own assets where the taxable gains would be realised at some point in the future, held more than 12 months, because the flexibility of being able to direct to the lowest taxpayer, including bucket companies, and get that discount was now massively disproportional to a company, precisely because the company's lost that indexation. Okay, so that seems to be missed in all this conversation, is what companies lost back in 1990 was the right to index those gains, and therefore companies now were punitively taxed relatively, whereas trusts and individuals were arguably kept in line roughly, depending on whether your growth rates essentially are double inflation. So what does that mean now? Well, now it means that rather than having a family trust as your primary investment vehicle, if there's going to be no difference in the assessment of the assessable portion of a gain, so go back to our example of we're going to realise a $100,000 gain in the future. If that's now realised under these new rules in a discretionary trust, then that $100,000 will be taxed at a minimum of 30% and then pass through to a beneficiary. And that beneficiary will only get that tax credit of 30% if they are themselves eligible to receive it, and a company, for example, is not. So let's walk through that. $100,000 gain in the trust, 30% tax paid. So that's $70,000 if then distributed to the company. That $70,000 is now assessable income to the company. And it appears, at least from the announcements, that that $70,000 would then pay 30% company tax. In other words, another $21,000 tax is paid. So $30,000 tax by the trust, $21,000 by the company. We now have a 51% effective tax rate on the assessable earnings or the realised gain inside the trust distributing to a bucket company. Whereas if that trust distributes to a eligible beneficiary, say an individual, even at the top marginal rate, then they're only going to pay a top up of that 17% in terms of actual top marginal rate. So again, let's walk through our tax brackets here. You can see, these are the rates for 25, 26. So you can see that once we get over 190,000 of assessable income, our tax rate is 45 cents a dollar plus Medicare, so it's effectively 47 cents because everyone who's earning over 190 is paying Medicare levy. That doesn't include the Medicare levy surcharge, because everyone at that rate should definitely have private health insurance because it would be cheaper than the Medicare levy surcharge. So yes, potentially, arguably there is even more tax payable potentially. And if you had a HEX debt, for example, some of those things might increase the effective tax rate at a particular point in time. But for the purpose of this, I'm going to ignore all of those because they probably won't apply at incomes of this level, or certainly not for very long because, again, private health insurance will be cheaper to take out in almost all cases. And even if you had a HEX debt, it would be pretty rapidly paid off at income tax rates at this rate. So it's important to keep in mind that there is no such thing technically as capital gains tax. Capital gains tax is a provision within the income tax law that says how much of a gain, when realised, is included in assessable income by that taxpayer in that year. So we can all be very high income earners if we realise large capital gains in a singular year, which largely is what we see, and again we talked about that in detail in the long form video recently, that the reason why the vast majority of high-end, the top decile taxpayers, are getting most of their assessable income as gain is because those people are almost always relatively one-off. Okay, we all get there when we sell our investment property or we, sell a very high gain in an investment company or something over a period of time. Very few people are paying, are realising the average of something like $800,000 gain. Very few people are realising that more than once or twice in their lifetime. That's the reality. So yes, the statistical category might suggest that people in the top decile based on income tax returns are ones, receiving this huge discount because they're realising a big capital gain. The reality is flesh and blood people are doing that very, very infrequently, if not in most cases only once or twice in their lifetime. So that's the that's the context around what the trust and bucket company strategy has been and why it's been popular and in place. And obviously, one of the main ways this might invert going forward is companies, investment companies, are likely to be a much more effective vehicle now for long-term investment and particularly long-term reinvestment. Now, that doesn't necessarily mean that the company can't be used as a very effective tax planning vehicle based on the way the company structures its shareholdings and how it might distribute income versus capital based on different classes of shares. Also, things like fixed trusts, which aren't going to be caught up, at least under the announcement, aren't caught up in this new treatment, can also be incorporated because they can operate very similar to what a company with different classes of shares. But I wanted to walk through this example because it's really important that people understand that the reason why that the strategy of using a discretionary trust to house growth assets or assets where most of the return might come in a one-off big lumpy, particularly things like investment properties, etc. Those big one-off gains might be realised to allow that income to be housed or captured. In this case, the example I gave is by a bucket company, where maybe that company can stream those earnings out in future years when those taxpayers are relatively low marginal rates. Because in reality, this huge gain is being realised in a one-off scenario. So rather than, and this gets into the argument of income versus capital and how should they be taxed, because the argument that taxing gains at the same headline rate as income is a fairer way to go, because someone who earns their money via gains should pay the same effective rate as someone who earns their money by income, is a false equivalence, because gains, first of all, aren't guaranteed the way income is year to year. Second of all, gains are often the result of value that's been created over many years, and there's no opportunity to take the $100,000 gain you've made or $1 million gain you made and run that over all the financial years where that gain was made, and therefore pay, across the tax scales. So again, as a small business owner, for example, people owning farms and trading entities, the fact that they're able to realise much of their ultimate return in their business towards the end of that life cycle when they sell the farm or sell the business and move on, they're not able to spread those gains across those years when they would have had much lower tax brackets. Particularly, farmers may have had many years of losses, for example. They can offset those losses against future income, but they can't claim back the $18,200 tax-free threshold that they didn't use for the decade where they didn't have any taxable income. So the idea that income and capital are equivalent from a tax perspective just isn't demonstrably not true, and trying to tax them in that way is obviously going to lead to a huge amount of inequities. So that's probably the number one question that we've been asked, particularly in detail, like what does this mean and how might this apply? I want to, again, just separate specifically here that we're talking about discretionary trusts and discretionary trusts that are in operation. So a testamentary trust, which is a trust set up via a will, which only comes into force when the will maker actually passes away, okay, that trust may also be discretionary, okay, but first of all, it only comes into existence once the will maker passes away. It doesn't exist because it's in your will. It comes into existence if it's in your will, has to be written into your will, and when you die. And most will precedents are certainly the ones that we use with the solicitors that we use for our estate planning purposes, do provide the flexibility to be able to have a number of different types of trust structures. It's not a singular thing, that allow flexible planning. So the vast majority of cases shouldn't need to update their wills, even if these rules come in as had, but you do need to check the provisions of your testamentary trust in your will, and that may need some updating, but not all of them do. So that's, again, before you run off and pay another few $1,000s to have your will updated unnecessarily, you need to make sure that A, your estate plan is going to result in having assets in the estate, because many estate plans don't result in the estate having any assets, because again, things like superannuation, family trusts, even potentially company assets can sit well outside of an estate in many estate plans, and increasingly so. So it's not just as simple as hey, because you have a testamentary trust in your will, you need to go and get your will updated. So if you've got any questions, feel free to reach out to us. But that's sort of a bit more of a deep dive into the trust and bucket company strategy. Again, we don't know how this will play out in terms of what the recommendations may be and how we might adjust this going forward, because we need to see the detail. But hopefully that gives you a bit of appreciation as to why those strategies have become popular. One, because of the removal of indexation for companies. So companies have been significantly penalised to holding growth assets. One of the reasons why they haven't been part of this regime. But that's probably where it will flip going forward. But again, we've got plenty of time to work this out. Once we see the legislation, there is announcement of rollover relief. So if this restructuring does need to occur, then people shouldn't be adversely penalised as a result of that change. So, got any other questions, let us know, but that's the deep dive on the trust and bucket company.